Welcome to TMS Insights. Summer's come and gone and reporting season as well. It's now March the 1st and Ben Clark and Jeremy Hooker here to bring you the update of the back half of reporting season. It was a really good month, the month of February for the market, up 5.5%, which means that we're back almost, Ben, to those September highs where the market began its descent into Christmas from.
Yeah.
But 2019 has been really kind to the market.
Yeah, it's amazing, isn't it? Because there was so much negativity around in the press and, you know, the experts sort of all predicting doomsday in December. And it just goes to show, I think, that it is impossible to pick short-term fluctuations. But I think that the pleasing thing is that earnings season has been probably at or above expectations. Yeah. And it's ultimately profits that drive company share price performance. And the other thing I'd point out is that it's been a really polarising market in that a lot of stocks are actually well above where they were back in September, and quite a few are well below it. So it's not like, you know, everything's just done what the market's done.
And to that point, I think 39% of the stocks that reported did better than expectations, so the consensus expectations, and 32% were below. So that's a win in itself because expectations tend to be lofty, they're on the high side.
Yep.
So doing better than that is certainly an achievement.
Yep.
And that speaks well for the market.
Yep.
Although we may have seen a lot of that priced in already.
Yeah, it feels that way. And I guess the other thing you'd sort of say was a bit of a theme was this return, getting cash back to shareholders.
Yeah.
We saw quite a few companies announce special dividends, off-market buybacks, and that's probably been a bit of a sugar hit in the short term to some company share prices. That might sort of drop off somewhat. So
some of the bigger ones, Wesfarmers, and they're already ex at $1 special on top of their $1 interim dividend.
Yep.
That was a big one. We know Woolworths has got something coming when the petrol stations sell. We know that Rio's actually announced a very large special dividend.
Huge.
So and the other companies, Caltex as well.
Flight Centre.
That was a big one. And so that's still cum dividend as well. Suncorp. When they sell their life business, another special dividend. Now, it's interesting here, Ben, because a lot of our clients, a lot of people are worrying about the change of government and what it might mean for franking credits.
Yes.
But I see this actually as an example of how in the market, the companies and the advisors, people like us, will find a way to work around it and minimise the impact.
Absolutely. And so we've got companies sort of saying, let's get it back now, particularly if they've got large retail shareholder bases. But I think the thing that this is going to create, and we've seen Jeff Wilson talking about this, is that the amount of money that Labor believe that they're going to raise out of the change in franking will be much lower than they're expecting because people are acting ahead of it. And so, and what also, and just the other thing I would also say, because I've had quite a few questions about, you know, change in government. The market largely has priced in a change in government. If the Labor government does win, which is looking very likely, we're not going to see a crazy reaction in the share market. We all know that that's very likely. Share prices are reflecting that. There might be some nerves as we get closer, but we might also find some of these policies are wound back a bit or take some time to get brought in.
Look, and I think that's the feeling too. They're going to probably have to deal with a hostile Senate, with crossbenchers with their own ideas. So it's certainly not a foregone conclusion, any of these changes. And it would be fair to say that Labor in government is never nearly as bolshy as it has been in opposition. Yeah. And it's actually been quite good for markets as well over time. So we don't necessarily need to overcomplicate this. Let's get into the detail of some of these reports, Ben. We had a lot since we last updated our clients here, and let's go through them. Ramsay was one, back in town. Ramsay's been on the sidelines from a market point of view for 2 years. We were looking at this coming into reporting. It did deliver a good result, Ben.
Yeah, there's a pickup happening there. We saw HealthScope also reported some better than expected numbers. So the Australian, New Zealand, I think that the thing I'd say is the clouds on the horizon are clearing for Ramsay. They really said the UK business, the France business and the Australian business are all showing signs of growth again.
Yes.
So that was definitely a tick. Ramsay still looks quite cheap versus where it's traded historically in terms of the PE. So there might be some more in this over the year.
A stock which we've widely owned that has had a tough time, it's really coming back strongly with a good result, was Invacare.
Yeah.
So the market was warmly supporting its result, and it looks like some of the investment is paying off for Invacare.
Definitely. you could almost put they're very different businesses.
Yeah.
One's at a later stage than the other, but the theme was the same, which they've both gone through periods which have been difficult. The results weren't nearly as bad as the market thought they could have been, but they've also guided to, the investment they've made into their centres is actually tracking ahead of their expectations. And also the death rate has reverted back to the mean, and the December-January period was much stronger. This was one that had a big short position against it. Nearly 14% of the stock was short sold. And, I think the stock's put on about 40% since it's reported, which is pretty incredible.
Amazing, yeah. So it just shows the role of expectations there, which is important. We'll look at next AP Eagers. Now, this is a stock from if you look at what the market expectations here, this company should not have done well. Car sales through the market and the economy were lower at the back end of 2018. That's the core activity of AP Eagers, owning dealerships around Australia. However, profit held very well, was up marginally, and the stocks performed well. Says something, Ben, about long-term management and long-term investing.
Absolutely. I mean, we know Nick Politis is the largest shareholder here, and he has been there for 20 years and has been buying shares virtually every day in this company. And there's two things here to me. First, they own a huge amount of property, which is a backbone of the share price, but also, not worrying about your next 6 months of earnings, worrying about the next 5 years. And we see this constantly with owner-operators. Over time, they tend to dramatically outperform, but they also go better in these sort of periods. And you're right. I mean, it's an incredible effort to have grown the profit given what new car sales have done.
Against that sort of macro trend, which is phenomenal. And I'll take that and roll into another family-owned company, if you like, Reece, which is the plumbing supplies business. A great long-term company. Hard to trade, doesn't trade a lot because of the Wilson family's large ownership. Roughly, we think around 60%. It's imprecise, though we might add. But they made the major acquisition of Morsco during 2018, and they updated the market in their half-year results, Ben. Yeah,
we actually had the presentation this morning. So this is one that I think looks really good over a long-term period. Reece has come back about sort of 15-20% off the high. I would say here that they're calling out a softening in conditions in Australia over the next couple of years. Although 50% of their revenue in Australia is renovations, which they said always hold up a lot better. But in the US, there's growth, and they're now the third largest plumbing operator, and it's in the Sunbelt states of the US, which is growing faster than the overall market.
Correct,
so, the quote I heard from Peter Wilson today was when an analyst sort of said, what's going on next 6 months with the US, he sort of said, you just got to remember, we're thinking 20 to 50 years ahead here. We're not thinking next year. And we're managing this business for where we want to see the returns over a very long period of time. And it really, to me, that rings a bell, and they're the sort of companies you want to be involved in.
And it's so like SEK when we hear from Andrew Bassett and we hear from these longer term companies, Soul Patts and the like, and we want to invest in these companies, and we love the fact there are short term people looking at these stocks and selling it on 1.5 year's results.
Yeah, exactly.
That's great long-term opportunities for us. So that's terrific. Let's move into another plumbing supplies company, Reliance Worldwide, which has recovered strongly. It's had a terrific listing when it floated. The Munns family is now completely sold down. And its result looked in pretty good shape, Ben.
Yeah, definitely. So this is another Australian-bred business that's really taking on the world. They're making significant inroads in America and really actually disrupting the way that work is done in the plumbing industry in America. And then, of course, they've made the next leap into the UK and Europe through John Guest. And I think with Reece and Reliance, what I'd say are big positives, because we've seen a lot of companies go offshore, make those big acquisitions, and it's been a disaster. And these have both got great long-term management teams. And, we're now getting some real track record out of these businesses, which really could generate the next decade of returns for them. And they're going at or ahead of expectations. So I think, both businesses well worth looking at.
Good one. IMF Bentham's one that's held. It's the litigation funder. Always a lot of work for them. Interesting result. Dividend not declared this time. So but they're generating a lot of new investment through their rest of world funds, and no lack of activity for them. So that was a good result.
It was a great result. And this is a tricky one. Like, reporting season to this company doesn't really matter. Cases get heard and then get pushed out and settle. And So it's a very messy 6 months
Lumpy,
to 6 months. But the casebook that they have over the next 5 years is, I think, at a substantial premium to where the share price probably is if you apply like a historical win-loss ratio to it.
Yeah. Couple that we should mention there, Costa Group reported, and Vital Harvest, which is the landowner for many of the Costa farms, Ben. An interest in both of these companies, but particularly Vital Harvest, which we listened to yesterday, and that was its maiden declaration of a dividend. Good numbers.
Yeah, I thought so. So the difference here is that Vital Harvest, of course, we've spoken about it before, owns a lot of the farms that Costa Group farm off. And I think the thing that the market still hasn't woken up to with this stock is not only do they get rent from Costa Group for running these properties, but they are also getting a 25% profit share, which will continue till the lease comes up. And then the base rent is going to kick up significantly, and they will continue to earn a 25%. So to me, it's a much cheaper entry point into what is a great business in Costa, with a land bank. And I think the yield that was declared was 4 cents, and that's just on 5 months of operation. So this is probably one of the best dividend yielding stocks in the market.
Unfranked, we might add, so it certainly doesn't run into franking credit issues. Now, before we go, last stock to mention, one of our favourites, always love listening to the SEK report.
Yeah.
It's a common theme, again, about investment for the future, long-term investment into their great operation. But there is growth there, Ben, even in some of the mature sides of the business.
Absolutely. This I think is looking really good over the next 5 years, because the share price, I'd sort of call SEK as a blue chip growth stock. And we've seen these newer growth stocks, particularly the tech ones, are trading at all-time highs, and SEK is quite a bit off. And they're investing so aggressively. You can see the revenue is really kicking hard, but all that it's being masked, the profit line, by the reinvestment. But Andrew Bassett on the call was really, again, thumping the desk and sort of saying, if you see the opportunities that we're seeing, we're going to plough as much money as we can into them. And we're thinking 10 years ahead. And again, if you're just interested in 6 months returns, we're not the company for you. So,
and particularly they gave some colour on Xiaopin, the Chinese business, which we hadn't seen before. And wow, that's looking really good.
That's great. So they had 37% revenue growth, I think. It's now the clear number one player in the jobs website in China. And again, everything that's going through that business is getting pumped back into it. And, Xiaoping in its own right, in time, could become worth more than the entire SEK group as at today. If they operate well and they've got the track record. So
it's looking good at the moment, so it should continue, and we're very keen again on SEK. So that's all we've got time for in this Insights. We'll wrap up reporting season and be back with you at the end of March.